Hi, I'm John Pearce, Chief Investment Officer. Welcome to this investment update. Over the past couple of weeks, I've been on a roadshow. And I know that many of you have actually attended that roadshow, so I'm going to try to not repeat myself too much. What I would like to do is briefly recap on the last financial year and the returns of the range of our investment options. And also I'd like to address some of the frequently asked questions that you asked me in the course of that roadshow. First, option returns. Here's a list of all our accum option returns over financial year 24. A big range there, not enough time to go through all of them. A few key ones. Firstly, our balanced option. This is our default option. Pretty solid return. Our sustainable balanced option, 3% higher. Therein lies the first question. Can that outperformance of the sustainable balanced, or sustainable high growth for that matter, last? Members love asking me for predictions, and I always try to avoid them because they're difficult. What I will do, however, is talk about the drivers of that outperformance. Let's have a look at the sustainable balanced option and its restrictions. We know that sustainable balanced and sustainable high growth cannot invest in fossil fuel companies. So you see them underweight the energy and materials sector, and they were underperforming sectors last year. Now, to counter that underweight, they're overweight in other sectors such as technology and communications, and those sectors outperformed. Tech sector was on a tear. And that explains the difference. Now, if you think about the dynamics of those sectors, can we expect to see a persistent outperformance? Well, not if history is any guide. Have a look at the past few years. In financial year 22, it was actually the balanced option that outperformed by about 4%, both of them down, but the balanced option less so. In financial year 23, about square, not much between the two. Then, of course, last year, we had a 3% outperformance of the sustainable option. What about over a longer period? What about over 10 years? Guess what? Identical. Of course, this is history. What about the future? Well, in the short term, what you'll find is the difference in those sectors will drive the difference in performance. Over the long term, our best guess is that performances will tend to converge. Let's have a look at the best and the worst. International shares, heavily weighted towards tech. Those big 6 tech darlings drove about 50% of the performance of that option. Right down the bottom, a laggard by over 30% global environmental opportunities. Of course, the inevitable question, what is the outlook for global environmental opportunities, or GEO as we call it for short? First point to mention here is that the returns are very volatile. If we go back to financial year 21, GEO returned about 50%. So the past 3 years, we've actually seen a give back of about half of that performance. But what about the prospects going forward? Well, let's have a look at a couple of the positive drivers. Firstly, the secular growth themes remain intact. Now, what do I mean by that? GEO is looking to invest in companies that earn at least 40% of their revenues from environmental themes, be that electronic vehicles, renewable energy, batteries, etc. This theme is still strong. In 23, there was a 50% increase in renewable capacity in the world. There was a tripling of storage. The theme's intact. Most importantly, we're not having to pay as high a price to access those themes. You think about a company like Tesla. Over the last 3 years, Tesla's almost halved in price. Generally, if you look at the portfolio in total, you look at something like the price-earnings ratio. This is just a valuation metric where we're comparing the price of the company to its profitability. What we're seeing now is that PE ratio for the portfolio is about where the market average is. In the heady days of 21, it was about double the market average. So here we have a situation with a portfolio with much better growth prospects than the broader market, trading on similar valuations. What about risks? Well, of course there are risks. Politics. Trump's attitude towards energy is drill, baby, drill. That's actually, I think, his motto. That would not be good for the sector. China is still flooding the market with EVs, with solar panels, etc. There are Chinese companies that are selling at prices below cost, which is not healthy. However, that cannot last forever. On balance, Geo is certainly on a more solid footing than it was during the heady days of 21, but there are risks. The concentrated nature of this portfolio means that it is going to be more volatile, so it really is only for those with a very long-term investment horizon. Geopolitical risk. Members came up to me and said, John, you didn't talk about geopolitical risk, yet it seems to be very elevated in our view. Well, I've mentioned about this before. I've been investing for over 3 decades, and I've never been in a situation where the world was totally at peace. Is the world a riskier place now? Well, that's quite subjective. The reality is that we've had weapons of mass destruction for decades. So, question whether the world is actually riskier now. Interestingly, what we find with geopolitical events is that the market tends to shrug them off. Have a look at this list. Here we have all the geopolitical events back to about World War II. And those bars are showing the Australian stock market performance 12 months after that event. Green bars, positive returns, and green bars dominate this graph. So markets tend to bounce back pretty quickly. What's the bottom line? We do not take geopolitical events or the probability of one happening into account when we're looking at forming our investment strategy. Turning now to our defined benefit division. Now, it's a subject matter that I didn't have time to cover, and some people say, why not? And fair question, because we do have about $35 billion in the DBD. So it is worth mentioning. Now, maybe it's complacency, but the reality is that we are in such a healthy surplus that I always say you've got nothing to worry about. A measure of the surplus is the Accrued Benefit Index, the ABI. Latest estimate is 133%. So that's a very healthy surplus. Now, the more insightful line of question I'm getting is, all right, given the size of that surplus, are you changing your investment strategy? And the answer to that is yes, we are. In fact, we are de-risking our portfolio. And how are we doing that? Well, we're selling down some of our listed shares, the more volatile listed shares. We're adding to our exposure of unlisted property and infrastructure. And importantly, we're also buying bonds. You might ask the question, well, the ABI was actually around this level 4 or 5 years ago. Why didn't you start de-risking then? Well, here's the answer. Back in 2020, shares were actually cheaper and bonds were more expensive. In fact, bonds, the return on bonds, were actually not meeting our hurdle return. Today, they are. The implication of this is actually much more far-reaching than just the DBD. Any investor now can achieve a desired level of return by taking less risk. This is a profound development. And finally, people came up to me and asked me, now what about the recent market jitters? What's causing all of this? Bear in mind, this happened after the US recorded its worst 3-day consecutive performance this year. And there are various explanations. There are the technicians that say, well, the September quarter is traditionally a a weaker quarter. So there's seasonal patterns involved here. There's a more novel explanation. Have a look at this graph. Did you know that in US election year, markets are weaker if the sitting president is a lame duck president? Just shows you there's a stat for every occasion. Are you buying that? No, neither am I. I think the answer is far more simple. The reality is that the market's had a fantastic run. The US market, over the last 38 weeks, 28 were positive. To get that sort of result, you've got to go back to 1989. So it's been a fantastic run. And when a market has had a run like that, it becomes susceptible to any negative news, no matter how small. And we have had some negative news. There is the US election uncertainty. Trump came out and said that Taiwan has stolen the American chip industry and hinted that the Americans would not defend Taiwan. Not good for tech stocks. And of course, we had the global IT outage, CrowdStrike, causing major disruptions. But most importantly, there has not been any change to the fundamentals. And the biggest fundamental of all is inflation. And if indeed inflation can continue on its downward path, I'm very confident that the market can maintain the solid gains that we saw last year. Thank you very much for watching.